Are you thinking about starting a real estate investment fund in 2023? Well, in this video, we're going to talk about the 5 questions you must ask before you start a real estate investment fund. Let's get to it. Hey everyone, my name is Mauricio Rauld and I'm the founder of Premier Law Group. We set up hundreds of these real estate investment funds, and after consulting with all of our fund managers, there are certain questions that tend to pop up time and time again. So in this video, we do a deep dive into the following 5 questions. And if you find value in this video, please consider liking and subscribing. Number 1, what security exemption should you consider? You've got a lot more options than your typical 506B or 506C when you're doing a real estate investment fund. Number 2, how will you accept your initial capital contributions? Are you simply going to take soft commitments, or are you going to take some kind of a deposit to ensure that when it's time to collect, the money will be there? Number 3 is, what will the length of your fund be? Is it going to be a set amount of time, maybe 5 or 7 or 10 years, or is it going to be an evergreen fund where investors can come in and out over the next 3, 4, or 5 years? Number 4 is, how will you raise the capital? Are you going to raise all the money up front in the first couple of months, or are you going to be raising the money throughout the length of the fund as you acquire more and more properties? Number 5 is, what is your exit strategy, not only for your property, but also for your investors? Are you going to allow your investors to exit at any point, or is there going to be a withdrawal process that they're going to have to follow? So without further ado, here we go.
The first interesting thing that pops up with funds is the exemption, right? So typically when we do a project specific, we're typically doing a 506B or 506C, but when we're doing a fund, we have a lot more options. Reg A, for example, comes to mind. That starts popping into the equation because a Reg A doesn't really work if you're doing a project specific because you don't have, 9 months to get it through the process. But when you're doing a fund, that's something you should consider. And maybe even regulated crowdfunding is an option, although the limits there are pretty low. So you're probably, if you're going to put the time and effort and money to do a fund, you're probably going to be raising a little bit more than $1 million or $1.5 million, which is the regulated CF limitation. But just think of that. So just open your horizon a bit more on the exemptions, because you've got a few more options when you're doing a fund, because there's no real time pressure as you do with a project specific. The other issue that comes up, which is probably the main one, I would say, when we're doing funds and structuring it, is how are you going to accept the initial capital contributions? One of the biggest fears that investors have or fund managers have is, look, they raise $5 million, $10 million into their fund to go buy whatever asset class they're going to go buy. And for whatever reason, they just can't find a property, and so, you're just sitting there with the capital in your bank account, and, are you supposed to be giving them some kind of a return? Is there a pref that's accumulating, or maybe you're giving them some interest rate, or maybe not. Maybe they're just earning zero and the investors aren't happy that their money is with you sitting in a bank account for 6 months. One of the things that we generally recommend, you take not a soft commitment, because a lot of people say, well, I'm going to take soft commitments because I don't want the money. I don't need the money until I find a deal. Problem with soft commitments, obviously, is that things happen, right? People commit to giving you 100 grand, and then 3 months later, when it's time to collect, they come up with whatever excuse. An easy fix, we believe, is to just sort of take an initial deposit. Most of the time, it's about a 10% deposit, but we have had clients do a 20%. It's whatever you feel is sufficient to kind of hook them in there. And so the mechanism for that is simply, we prepare all the documents just like any other syndication. You got the PPM, the operating agreement, all that great stuff. But they subscribe for $100,000, but instead of wiring you $100,000, they're going to wire you $10,000, and they're going to wait for you to tell them when you need the other 90. But when you need that other 90, within whatever days we put in there, 3 days, 4 days, 5 days a week, whatever we say, if you don't give us the remaining 90 grand, then you're going to forfeit that 10% and you're not going to be in the deal. Is it going to be a finite length like your typical project specific? Is it going to be a 5-year fund, a 10-year fund, a 3-year fund, or what have you? Or is it going to be one of these evergreens? And by evergreen, it simply means it's sort of this open-ended fund that doesn't really have an end date. You just constantly have it open. The evergreen comes with a lot of hair. Because it's an ongoing raise, facts are constantly changing. So you're continually adding, assets to the portfolio. Your financials are changing. There's a lot of updates that we need to do on the PPM and the offering documents. Because if you can imagine, when you just start your fund, you've got nothing in there, right? And so, you're just raising 50 million or 25 million or 10 million to go buy, and you describe whatever you're buying. But, a year later or 2 years later, Well, a lot of that isn't really pro forma. Now we actually have actual data. We have 2 years of financials or a year's worth of financials. And some properties may be doing great. Some properties maybe not be doing so great. So, but at least once a year, if not more regularly, if there's more material changes, we're going to be updated our docs. So that's something you want to consider when you're doing an evergreen fund. And then the other issue that pops up with evergreen is pricing. Somebody that comes in right at the beginning of the fund, are they going to pay the same price as somebody that comes in a year from now or 2 years from now, right? It creates a lot of issues. So unless you're doing sort of a flat return, like I'm giving everybody a 12% return and it's flat and it doesn't really matter whether you came in on day one or in day 200. If you're not giving people flat, then it's, as you can imagine, it's not super fair for somebody coming in at the end to be paying the same amount of money that from the first person, that came into the fund that's, arguably putting in a lot more risk because it's an unknown commodity. So typically what happens is you have some kind of a pricing structure where it increases typically based on NAV, on net asset value, but you need some kind of formula ahead of time. You need to structure that formula and disclose that to the investors so that that, hey, today the price is $1,000 a share, but once we start getting assets or whatever, this is how we're going to calculate increasing things. So how are you going to raise the money? Are you going to raise all the money right away in the first couple of months? You're just going to say, hey, look, I'm going to go raise $10 million. I'm going to raise as much money as I can in this 3 months. And if I get to 10 million, great. And if I don't, I'm going to shut it down. Or are you going to just sort of continually raise, even though it's on an evergreen, you may shut it down in a year or less. You sometimes raise enough money to go buy the first property, right? And once you buy the first property, then you continue to raise, so on and so forth. The other issue that really pops up when you have these delayed funding is the audited financials. Most folks forget that when you're doing a 506B or 506C or any Reg D offering, one of the prerequisites is actually that you provide audited financials to your non-accredited investors. So I guess this theoretically only applies if you're doing a 506B with non-accredited, but you're obligated in general. This is not just for funds, but in any 506B deal, you're obligated to give them audited financials. Now, the reality is when you're doing a project-specific deal, there are no financials, right? It's a brand new entity. We create brand new companies. And so there are no financials, let alone audited financials, which is why it's not an issue. That's why you never really hear about it, or nobody's ever asked you to say, hey, let's put together audited financial statements. But if you're delaying collecting the money in the funds, or if it's an evergreen fund, well, now that's different. A year from now, you are going to have financials. You're going to have, a year's worth of financials, or 6 months from now, you're going to have financials. So you're still raising money 6 months or a year, or certainly more than that, from the time you started the fund and actually had all the docs done. You're probably going to have at some point, and talk to your legal counsel when that magic time arrives, but at some point, 2 quarters, 3 quarters down the line, you're going to be obligated to hand your investors audited financials if they're not accredited. And as I mentioned earlier, even if they are accredited and they're all accredited, I would definitely be sending them financials in general. I mean, like, I'm an investor. If I'm investing in a deal, I'm going to want to, and this company's been around, this fund's been around for a couple of years, I'm going to want to have access to the financials, even though they're not audited, so I can see, how much money's in the bank, what properties do you own, what's the cash flow looking. So I'm making at that point, I'm almost making an investment in the particular company. What is the exit for your fund? And when I say exit, I'm thinking of two different things. One is the exit for the investors, and one I'm thinking of the exit of the property. So let's take them one at a time. Exit of the investors is like, again, if you've got a 10-year fund or 15-year fund or an evergreen fund, are investors sort of locked in for the entire 10 years, 15 years? Or are there withdrawal windows where investors can actually, give you notice and say, look, I've been in this fund for 5 years or 2 years or 10 years, I want out? Number one, are we going to allow them to get out? Some people don't. People say, look, I'm doing a 5-year fund and you're coming in today and you're not going to be able to get out until I liquidate everything in 5 years. That's probably the easiest. That's great. But if it's more like a 10-year fund, you're going to get some pushback. Some people aren't going to want to have their money locked in with you for 10 years. I would caution you not to have huge timelines in between those windows, because think of it as if you can only get out every 5 years, for example, say, well, you're in for the first 5 years, you can then get out, but then you're stuck. If you don't get out, you're going to be stuck for another 5 years. What's going to happen is everybody's going to want to get out in 5 years because they don't want to wait for the other 5. So that's something you need to consider. If 75% of your people want out, then you're going to start having to liquidate your properties, and it may not be the best time to liquidate them. So that's something that we spend a lot of time on. In fact, one of the things we tend to do for our clients is just to make sure that if there is a withdrawal provision, we have it there for a long time. I mean, you've got to give notice, you know, not 6 months, but probably 3 or 4 months before the end of the year. And then you've got another 3 or 4 months, you know, after they give you notice to actually, you know, get you the cash. So it ends up being a good 6 or 7 month window that you have. That's the number one question investors are going to say is, hey, how do I get my money out? If this is a 10-year or an evergreen, how do I get my money out?
If you enjoyed this video and you want to check out the entire episode, click here. And if you want to see another similar video, click here.